Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending August 5, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is it is a complex market. We're going to see some complex markets. Let me just kind of go into a little bit of detail here. Let's take a look at this prior week and just kind of see where action is. As you can see, everybody's in the green year to date, or in the red year to date, but this week, all green with the exception of the Dow. Okay. Both NASDAQ and Russell had a strong week, NASDAQ having the strongest. The Dow was the only one to finish in the red for the week. So it's kind of a mixed market, but there's concerns that the Federal Reserve is going to need to maintain a little bit more of an aggressive interest rate hike based on the economic data that came across the transom this past Friday. We got the Friday jobs payroll. It showed that employers added a little over 500,000, 528,000 non-farm job payrolls in July. That was more than double the consensus of 250,000. So it's a strong number. In addition, unemployment fell another 10 basis points down to 3.5%. That's matching its February 2020 level. That was pre-pandemic. Job gains were really widespread, leisure, hospitality, professional and business services, healthcare, all of them. A lot of the sectors showing strong gains. We also saw the service sector ISM data also expand as well, and it came in above expectations on the ISM, right? So the manufacturing sector growth also came in above expectations, but it still fell to its lowest level since 2020. So the economy is, folks, slowing down just a bit, okay? And you can see on the PE ratio, we're sitting at a forward 1822. So the PE ratio is slowly moving up just a little bit. Dividend yield for the S&P is at 1.58%, 10-year Treasury 2.84. So the Treasury is about 126 basis points higher than the dividend yield. And the earnings yield is sitting at a little under 5%, okay? And the S&P yield over the 10-year Treasury is at 2.11%. And the real yield is still negative. That tells me that inflation is still very active, very hot, putting downward pressure on the economy. And the Feds they're not anywhere near a neutral rate. They're going to have to get a little bit busier hiking the rates. So we're going to see probably some stronger rate action in the near term with the Feds. And the VIX, essentially flat for the week. It came in at 21.15. Last week is at 21.33. So it really didn't move that much. Okay. And we've seen the markets interpreted Fed Chair Boom Boom Powell's comments from a couple of weeks ago at their central bank meeting as dovish, but now they're pricing a little bit more of a rate hike come September of 75 basis points versus 50 basis points based on those hot job numbers. The probability went from 29% to 48% to 65%. So now that's kind of what we're looking at, what the markets are looking at on the next Fed meeting in September. Okay. If we come over and take a look at Europe and see where they are, you can see everybody was in the green across Europe. The Euro stocks, FTSE, CAC 40, DAX, all in the green for the week. Year to date, the FTSE is the only one in the green. The other countries, DAX, CAC 40 stocks are in the red year to date. So, but Europe is going to be in worse shape than the U.S. Okay, Bank of England, first of all, raised their rates this past week, 50 basis points to 1.75%. That's the biggest increase that Bank of England did in the UK in 27 years. Huge. They're also, by the way, projecting inflation hit 13.3% in the fourth quarter. That's huge inflation numbers, guys. That is really going to weaken not only Great Britain, but I promise you that it's also taking effect all across Europe. Okay. In fact, the unemployment rose across the Eurozone for the first time in 14 months this past month in June. The jobless rate remains unchanged, but you got a number of job seekers increased just under 11 million. Okay, the Eurozone manufacturing sector contracted last month, and so we're seeing this data showing a sharp decline in manufacturing all across Europe. Job seekers increasing, inflation increasing. So this is just going to put a strong squeeze on the European markets, very strong squeeze. Then, of course, if we look over at Japan, you can see over in the Asian markets, Japan, the Nikkei was up for the week. China was down a little bit. Hang Seng was up, but there everybody's in the red. Okay. Japan, we've seen wages over there rising higher while growth has been a bit muted, but the Bank of Japan believes that wage increases are necessary to achieving their inflation target. So what they're doing is a government panel had agreed to a record hike in average minimum wage for all workers for fiscal year 2022. Okay. So that, and we're seeing the composite PMI data signal that the private sector output pretty much was running flat in July. So not much going on there. They're still trying to figure out ways to get their inflation up. In China, you got a lot of moving parts. On the economic front, PMI fell to 49, so that shows contraction. Now, keep in mind, China's been pretty much shut down since March. They've been opening up in May and June with their zero COVID policy, which I think is just totally crazy, but that's what they want to do. But their PMI fell to 49, which is anything below 50 is contraction. Their non-manufacturing business activity fell to 53.8, which is low for China. And foreign investors, we're seeing they're cutting their holdings in Chinese bonds and they're dumping equities for the first time in many months. So China's having a hard time of it on the economic front. And then on the geopolitical front, with 5G Pelosi's visit to Taiwan, they're being very bellicose and doing a whole bunch of things over there for that. So it's just creating a lot of tension, and a lot of money wants to avoid those kind of hassles. So that's why we're seeing the outflow from Chinese bonds and equities this past month or so. Okay, so that's what we've got going on right now. A lot of activity. What I want to do is switch the screens here. I'm going to take you over to the E-mini S&P 500 futures. Let me just get that screen up for you guys. It'll take about 15 seconds for the screen to show. But what we want to do, I'm going to show you the key hard numbers on resistance. You can see this because the 50 is below the 200. It is a bear market chart, and obviously in a bear market chart, first point of attack is the 50 EMA, the second is the 200. And we sat here on the 50 for over a week, and then we finally were able to take it out, okay? And right here after the Fed meeting, you can see how this dovish market just took right off, and now we've run into another brick wall at this 23.6 fib node, which is just sitting slightly below the 200 EMA. Okay, you're seeing this is an Elliott wave 3, so perhaps we could move down and then move back up and take these levels out, but time is going to tell and where this thing goes. Okay, and that's the S&P 500. And if we look at the Dow, it's going to look very similar. You got the 50 EMA. We bounced off of that really strong right after the Fed meeting, and then we're just sitting right here right now. And you could see over here where we could not get the energy to break the 50 EMA. Over here we did, and now the next overhead resistance is going to be around 32,300, where the 200 EMA is sitting. And then, of course, if we look at NASDAQ, it's going to show a similar result. You can see on NASDAQ, we bounced off of the 50 EMA. We broke it, but then we did a retest. And then right on that bar right there, that was the day that the Feds announced, and it was viewed as dovish. Off we went, all right? And now we're sitting right at that level right there. So this is a little bit about what we're faced with right now. So unless we can get over that 200 EMA and then find it as support, we're going to roll back over again, guys. It's just as simple as that. And of course, if we come down here and we look at volatility, if we look at the VIX, you'll see here, it's just steadily been coming down in an orderly way. Very similar to this move here, similar to this move here. Now we're coming back down again here. I don't believe it's going to go below 20. We get inflation data next Wednesday. If it comes in hot, or we get more speakers from the Fed saying they're gonna be aggressive in cutting inflation, then you'll see the markets kind of give it up a little bit. Okay, and we'll stay north of 20 in the VIX. If we look at the front month skew, which is comparing the VIX to the August volatility futures, we're in the green. So that means we've got a contango skew. So that means the markets are not that concerned. And if we go to the back month, comparing August and September's volatility futures, we're well into the green. So again, there's not a lot of fear in the there's not a lot of fear in the market right now. And we're clearly in a buy the dip kind of mode at this point in time. Okay. And if we come down here and look at bonds, bonds did a hard move to the downside, which meant interest rates did a hard move to the upside. Over two handles, we came down and kissed the 50 EMA. Now, eventually, this is going to reverse and go back up. Why? Because the markets are going to be afraid of the slowdown in 2023, which makes bonds an attractive alternative investment or a vehicle compared to equities, and it'll drive interest rates as well lower as more people get into bonds. Right now, we're running sideways to slightly down based on, and this was based on that jobs number, right? And if we look at interest rates, you'll see the 10-year interest rate also came down, is coming up and testing the 50 EMA. We may run up a little bit, but I expect interest rates to come back down even lower than where we were here. All right, my forecast for the end of the year was below 2.5, okay, sitting right around the 200 EMA at 2.38. So why would interest rates be coming down when the Feds are hiking rates as fast as they can? Well, first of all, this is the 10-year. 30-year also. They tend to be more precursor of where the markets, where the economy is going to be 6 months, 1 year out in time. So this is the vote the economy is going to be weaker. That's what the bond market is saying right now. And pricing in, they're not pricing in a recession, but they are pricing in a lot weaker economy in 2023. Okay. If we come down here and look at currencies, look at the dollar, it bounced perfectly off the 50 EMA right here and right here. I think the dollar will move up. But remember, it's not just the dollar, it's the dollar index. And what moves that dollar index are a basket of currencies. But the primary mover and shaker of the dollar index is the euro, yen, and pound. Those three are about 80%, roughly a little bit more than 85% of the dollar index. The euro is almost 58% by itself. Yen is just slightly under 14%. The pound is just under 12%. So where they go is where the dollar is going to be driven, right? So if they go higher, dollar goes lower. If they go lower, dollar goes higher. And in times of stress, money tends to go to the U.S. markets, into the dollar, and out of the euro or the yen or the pound. Okay, so I suspect the dollar is going to run up a little bit before it starts getting weaker later on this year. Okay, and if we look at the euro, you'll see the same thing. The euro is stuck right now, going nowhere. I mean, we're just stuck on this level right here. You can see right here, we spent over 3 weeks trying to get over the 50 EMA back over here in early April. We couldn't get over the 50 EMA. Right here, we couldn't get over the 50 EMA. So now, if it runs up, that'll be a big marker for the euro. If it climbs over the 50 EMA and holds it, then we could have a nice little run up to the 200. But Europe is being in worse shape than the U.S. I think there's a higher probability of the euro going below parity than going up. All right, parity meaning taking out these lows and going less than 1 to the dollar. Okay, and if we come over here and look at metals, gold is still, I think, longer term or near term is probably going to roll back over. You can see how we've had a good move in gold off these lows. It was down at 1678 and we closed at 1792, just around 1800, which is kind of a psychological level for gold right now. But I do believe that we're going to roll back over again and come back down and test these lows before we have a final blowout, and then we start moving higher again. Same thing with silver. And then, of course, if we look at copper, copper is a vote on the global economy. And if you look at this, you can see where it's just been rolling over. And then right here, it's just the global economy came down pretty hard. In the month of June, just not very nice at all, right? And then going into July, we've seen a little bit of a bounce, but this bounce is probably going to roll back over again, right? Copper's an industrial metal. It's used for build out. China is one of the bigger buyers of the commodity. And they warehouse a lot of copper. So they've probably got, their warehouses are probably filled to the brim with copper because their real estate market, they've slowed down so much. They're probably not doing a lot of drawdown in copper right now. So that's weakened copper, the commodity on an international stage right now. So that's kind of what we're seeing with copper. Then, of course, if we look at the energy market and we look at oil, it was essentially flat on Friday. But you can see here how we spent weeks testing, almost a month testing the 200 EMA, and it finally broke early August, and now we're down here. I do believe oil is going to come down to the mid 80s. I mean, that was kind of where I said anyway. And then we're going to chop around a bit right there. And you can see here where the 200 was the final drawing line, and it gave it up. You can see this MACD, that just shows nothing but chop, right? Sideways movement, up and down, up and down, up and down, but slowly to the downside, not the upside. Now, I like nat gas. I'm long nat gas, been long nat gas. And you could see here, now up in this level here, I was telling our members to short it, but I think nat gas, we're going to be the #1 supplier to Europe right now. We're actually supplying, believe it or not, more natural gas to Europe than Russia right now. Primarily because Russia is only delivering 20% of their capacity in the Nord Stream 1 pipeline. But they're doing that on purpose. So the U.S. is providing a lot of nat gas to Europe. We'll provide nat gas to Japan. I think we need to get more LNG terminals down in the Gulf, and I'm sure they'll be working on that to put that out there. But longer term, I like natural gas to the upside. Okay. All right, everybody, that's just a real quick and dirty on where all the markets are right now. Members, I will see you this Sunday evening for our weekly market watch. If you're a non-member, I highly encourage you to come in and check us out. We're doing well this year, and next year it's perfect market for us. So have a great one, everybody. Have a great weekend. Members, I'll see you tomorrow night for our weekly market watch. Take care, folks. Ciao now.